Good morning, Craig. How are you?
Well, thanks, Brian.
I'm
Doing well.
excited to have you on the show for for a variety of reasons. One is that the concept of executive compensation, annual bonus programs, cash bonus programs, long-term phantom stocks, all this has been of a topic that a lot of entrepreneurs are interested in. They've heard good stories, bad stories, and up until our conversation, I hadn't really seen a whole lot of really creative things besides just, a basic phantom stock plan, or it was loaded with insurance. And the conversations that you and I and Pat had with what you're doing at VisionLink, pretty cool stuff. Honestly, I was very impressed. And we have a lot of common themes that are involved. And I think what we should do is just give you a little bit of your background, how you got to where you are today, what you guys do, and then we can kind of pick up and talk about normally what entrepreneurs do, which may or may not be the right approach, and when they're just randomly giving away equity versus some of the concepts that we're going to be diving into.
Yeah, no, that sounds great. Yeah. Our firm, the VisionLink Advisory Group, founded in 1996. So going on our 25th year here coming up. And we are, if you had to put us in a little bottle, we'd be a boutique style compensation consulting firm. But really what we are trying to do is really help entrepreneurs, business leaders, really build and sustain a high performance culture. I think if they can do that, they can start to accelerate performance, and doing that through some pay strategies that ultimately can transform employees into growth partners, I think is the biggest thing that we add here. Because if you can do that, the quality of talent that you have is going to improve. Employee engagement will be better. The performance is certainly going to be magnified, growth accelerated, all the things that entrepreneurs are thinking about here.
Yeah, and I'm excited because we're going to get into some of the mechanics about how to actually do this, because there's so many times I get people where I don't think this question has ever been answered that well. And so you and I are going to dive into kind of the different types, annual versus long-term value creation, and mechanically how people are doing this. And so as we kind of just tee it up, and maybe just give a little bit of your background, how you got into this space, because again, when I got introduced to you, I was very skeptical because it was like, oh, great, another split dollar long-term, insurance specialist. Can't wait. But what you guys are doing is different. And I think it's important to shed some light on how you got to where you are, because when we had the conversation and you're dropping the finance terms and value creation and EBITDA and value growth, I was like, whoa, this is actually way different than normal. So
Yeah. So it's kind of where we came from. I think there's 4 partners in VisionLink. I'm one of the partners, and we all started our careers in the financial services, insurance, and investment business. And we were all together at one firm, and we just migrated towards entrepreneurs. I think at heart, we're all entrepreneurs, and we're looking to build something as well. And we found the product solution to all of these problems is certainly viable, but there's a step before that, I think, that we found that basically says this: we need to look at the whole offering of compensation, and financial services tends to look at one or two pieces of it, whereas we said let's start looking at the whole of that as well, right? So that we can really address in these the issues that the entrepreneur is thinking about here. So we started in financial services, but within no time we were building long-term incentive plans in the form of deferred compensation. And like you said, either using split dollar insurance or trying to use corporate-owned life insurance or some of those things. But really, that's just the funding mechanism for the actual solution that a business owner is looking for here. And so we, I think like any business, we started having our clients say, hey, can you help us build an annual incentive plan? And we said, sure. And they say, well, how do you do that? And we said, we'll get right back to you, right? And we'll figure that out. And so we really, instead of looking at it from that benefits perspective, we started looking at it from a performance perspective. And before you knew it, we're in the compensation consulting business. And I think really even within there have specialized and become what we believe is, experts in building incentive structures, both short and long-term incentive structures.
And we're going to get into some of the mechanics of how you actually do that. Maybe even kind of give some examples. And I think what's super interesting, Craig, is that if you think about both your and I's, where we've come from, it all boils down to everybody needs to grow a more valuable company. And how do they do that? And if you got the right financial clarity, you can tie everybody together. And I've talked a lot about ESOPs on the show, and I think with ESOPs naturally get this involved because everybody's focused on value creation. But if before an ESOP and before any transaction, the number one thing that's most pertinent to the owners are, I need to grow a more valuable company. And I'm layering some foundation here is, I think, Craig, what you and I have talked about, like the annual income, that there's a shift in mindset a lot of listeners are listening in of, I need to focus on the long-term value creation, not the annual income or my job. And so many times I remember exactly where I was at this conference. I did this keynote. I went to the bathroom and there was this EOS implementation presentation. And then they come in and they're talking about hiring implementers, which is just essentially the GM, right? The integrators. And so they were just essentially trying to hire a president or a GM. The amount of people that I heard just saying, well, we should just give them equity. Because essentially like the goal is to hand over the reins for someone to grow, but there's a misalignment with like, okay, if you give equity without the future growth, then you're creating problems that you don't necessarily foresee. So I think as we're focused on this, it's about whether you have $100 million company today or $1 million, it's about future value growth and tying people to that. Right. So I think there's just a big challenge when people maybe we can talk about like the things that you've seen over the years, people that do things like I was saying, where they just give equity, or the things that people do wrong and the consequences of that.
Yes. Yeah, you do see it a lot. And I think it stems from really not necessarily having a compensation philosophy. I think, everybody understands they want to grow their value over a period of time. I mean, I think that's really where entrepreneurs are focused. And I think you have to understand your key people are focused on that as well. And so I think the first step is to define what that value creation is for everybody, right? What is value? How does this business create value? And then ultimately you can develop plans that are there to share that value, right? And so it can be kind of one philosophy, as we like to say, but two performance periods, right? I think if you're too focused, there's a short-term period, right, which is almost always based on profits. How do our profits look this year? We'll pay short-term incentives or annual bonuses or whatever terms we want to use. And then there's the long-term value creation, right, that rewards you for building enterprise value over that period of time. But defining that first and getting people to understand, hey, here is our strategy. Here's our vision of where we're headed. Here's how we're going to get there. And here's what's in it for you if we get there. If you can do that for people, that's how we came up with our name, Vision Link, right? Is linking those two visions, the vision of your organization with the vision your people have for professional growth and rewards.
What are some of the biggest myths that you see, or like the wrong thought process when someone says, oh, I've tried this executive, but you probably get it all day long, right? Where this didn't work, or what are when someone comes across and they've had a failed executive comp plan, what are the typical failures?
Yeah, I think first and foremost, it's over-engineering, right? I think people, especially in short-term plans, bonus plans, right? I think people really just over-engineer because they're trying to influence behaviors, right, with the incentive plans, people, and believe in that, instead of just defining the results that are considered success. Right. And kind of that, hey, we're all in this for the business success. And if you define that success, it's easier to build a plan around that than trying to manipulate behaviors all the time. You just can't. People are your people. You hire them for the reasons you think they're going to help you grow your business and grow value. And so then don't try to over-engineer a plan that influences or manipulates their behaviors, right? You hired them for the results they can produce. Let them produce them, and then reward them if they do or don't do that. And so I think it's over-engineering is probably the first step, especially in the short-term plan. I think as you start looking to, I'm going to use the term long-term plans here to refer to equity or synthetic equity or any kind of long-term sharing where we're measuring improvement over time in something, EBITDA, or business value, enterprise value, whatever that is over time. I think when it starts to relate to that, I think you get the biggest mistake is business owners are afraid to share that value because they don't know what it means, right? They don't know if I give you equity today, if I give you 1% or 2% or 5% or 10%, what does that actually mean? And what about all the pitfalls along the way? And what if I make a mistake? What if I really 2 years down the road go, wow, this wasn't the right guy to give this to? It's hard to unwind. So I think it's hesitation in long-term and actually implementing a long-term plan or value sharing philosophy. It comes too late for a lot of business owners.
It's interesting that you say that, because I think one of the biggest observations I've had, Craig, is that most people don't understand valuations. So therefore, to be able to align all the stuff that you and I are going to dive into, you can't really do that unless you have a foundation that says, hey, here's par value. Today, based on $1 million in EBITDA and an enterprise multiple of, enterprise value of a multiple of 5, we have a $5 million company. If I'm trying to hire an executive, I want to reward them on future growth. I don't want to just give them equity. And I think, I think it'd be fun to go through a quick example, and then we can talk about all the different ways that you can creatively structure this. But it's like, I think as people go through and they clean up their financial foundation, the things that we talk about, getting the 3 financial statements, tying them together, understanding that true value right now. If they're going to hire a heavy hitter, which you can build an insane business around a bunch of 10s, people are going to come in, they're going to say, I want X amount of money, which is usually a high payroll that the owner may or may not be used to writing a check for someone else that's paid that much. They want an annual plan, and then they want future equity. They're going to immediately say that, but I think what we can talk about is how it's not necessarily equity, but you can tie this all through future value growth. So kind of explain maybe the results of when you're linking those couple of visions, and then we can go and dive into some of the creative nature of what we can do.
Yep. You're going to hear me say this a lot today. I think as that business owner thinks about hiring that person you just described there, he needs to come at it prepared in the form of he needs to understand and have a complete grasp of what his compensation philosophy is and why it fits and is going to make this business successful, right? And so, look, everybody coming in wants the best deal for themselves, but the best deal for a business, especially a growing business, is going to be let's construct a pay package that controls my fixed compensation costs first and foremost, right? So paying salaries, maybe slightly below the market salaries, right? Maybe close to the median or slightly below. With a benefits package and a retirement plan and those types of things that are my fixed costs that I have to pay no matter how well we're doing, keeps those under control, and then is able to say, we have the perfect incentive plan, right? It has 2 performance periods, and it entails short-term incentives based on our annual profits and long-term incentives or long-term growth based on enterprise value and that growth in enterprise value. And so there are multiple ways then to do that, right? When I have my philosophy and I'm confident in my philosophy, then we can construct those plans that say, here's how we're going to do that for you over this period of time. And you're exactly right. If you've spent, the last however many years, 10 or 20 years building your business up, and you have some value already, in the example you gave, $5 million of value, why do I need to share that with somebody who's coming in? I'm bringing this person in, typically, like you say, to grow the enterprise value of my business. And if everybody believes in the vision and the strategy and how we're going to do that, then sharing that upside value is easier for both parties, right? The person coming in can see that opportunity, and the existing business owner can share more of that appreciation in value because it's only going to happen if we create that new value.
So there's a couple of things you just mentioned that I think are awesome, and they're validating some of the previous interviews I just had recently. That there was this woman named Allie Taylor. We were talking about essentially the personality traits of entrepreneurs and how their ability to understand complexity and their desire for control actually allows them to hit the ceiling. So she said that the more you give up control, you can 2x your business because of it. And so when you're talking about giving up this control and sharing future value, I talked about it with someone. I said, when you build out the phantom stock plan, you're saying, okay, whether it's 5, 10, 15% of the future growth, can you hit that or not without your people? And I don't know what your thoughts are, Craig, but I have yet to find, the 12 out of 10 players that are willing to come in just for $120,000. They're either going to say, I want 50% of your business right now. Most really good people that are executives understand value, so they're going to request it. So you might as well suggest it to them instead of overgiving.
There's no question. The long-term piece, the synthetic equity, phantom stock, actual equity should be the crown jewel of your offering to these people, because it's what speaks to them more than anything else. So if you're really trying to hire somebody, and this is a high-powered person who you know is going to be able to create value, this piece needs should really speak to them, right? It should say to them, I believe you can create value, and if you do, look at this plan that we have that will share some of this value with you when it's created. And so it shouldn't be, if you're an executive or you're a shareholder and you believe that your growth projections you have for your business and value over a period of time can happen no matter who's sitting in your key talent seats, then it doesn't matter. You don't need a plan like this if you believe it can happen. But if you get to the point where you fully understand that what's possible with the right people in those seats, these are the easiest dollars to spend in all of your comp projects, and you hit the number on the head, right? If we're going to build a plan like this, you might be sharing 5, 10, maybe 20% of the growth in value over some period of time. Well, guess who gets that other 90, 80, 90%, right? That's you as the shareholder. So
with hopefully less responsibilities, right? I mean, that's the whole point. And so just for some clarification of some of these terms you've been throwing out there before, because I want to get, before we get into like an actual example, and we get kind of some, show some examples of how you can get creative on this. Your definition of phantom equity, synthetic equity versus real equity, and then the differences between the two.
Yeah. So I think it's easiest to start with the real equity. So regardless of your capital structure, if I'm an S corp or a C corp, right, we have issued shares, stock shares out there, which you can use in a compensation plan, right? We can give those shares out, and then we bring on all the issues that come with that. It's not insurmountable. There's nothing wrong with using actual equity. You're just making a little bit more permanent decision. And tax-wise, we get into some other issues here along that way, right? If I use actual equity, then a person needs to pay their income tax as those, whatever you gave me, vests, right? And so now you're giving me a piece of paper and ownership in a private company here, and I have to write a check to the IRS potentially to do that. So, and then I have minority shareholders, right? I have a minority shareholder or shareholders now, depending on how I'm doing that. And so if we're a pass-through entity, I'm issuing K-1s every year for tax purposes and all the rest of those things that go with that. They have rights to see books. They have all types of rights to look at those types of things. And so it's been around for a long time, that the term phantom equity or synthetic equity, or whether you can use any term we want. I think people have various feelings about things of the terms. You can actually call them anything you want, but really what it is I call it, it's really a value tracking stock, if you will, right? Because it is not tied to your actual equity at all. It's a compensation plan. So phantom stock is a compensation plan, a long-term compensation plan, where the metric is the business value, right? Where we're saying we're going to track this business value over a period of time, and we'll share some value from it, either actual value like a share of stock, or appreciation in value like a stock appreciation right. So it's just constructed. Once we decide that, we can construct it almost any way we want. We create a valuation, or we can use a third-party valuation. We create the number of shares in there. We give those shares away. We track those shares. And ultimately, we typically settle them in cash. That's the major difference, right? It's a cash-based plan versus an equity-based plan, although they have a lot of flexibility. So if you're unsure on equity at the beginning, but ultimately you might want to use that, you can settle, meaning when it comes time to pay for my phantom stock, I can pay them in actual equity. So I can save cash later and pay in equity if I really want an equity partner.
So thank you very much. That's super good for the foundation. I think what we should do, Craig, is kind of just take like a hypothetical example, just kind of walk through the decision-making trees as people have it. And the one that I love is that I think a lot of people can relate to is they start off with, let's take that $1 million in EBITDA, and let's say it's worth $5 million in value. And, based on our intentional growth principles, that's number 2. If an owner is saying, you know what, I want to go from 1 million in EBITDA to 2 million. So I can go from a $5 million valuation to 12. And that way I can hopefully, when they get to the 2 million in valuation, they might target an ESOP or target a private equity recap, but they're going towards options, which is kind of that they go from no man's land to the ability to have more options. So therefore, there's this value gap growth that they need. And usually, if you think about all the all the material that they have to have done before this. They have to have clean financials. They have to have a true indication of value, right? So we're not going to be diving into all that stuff that they should already have done, but they have this journey that they want to go to increase value. And now they need to essentially hire the players to get them there. So I think let's talk about for the annual, like what are the ways to do this when they're recruiting something or someone, the annual bonus plans, how does that work? And then what are the different ways you can kind of just talk about the shares and the vesting and how that would work to go from the 5 to 12 million in valuation. I think it's a very specific target and roadmap that people are looking for. And then we can talk about at the end, what happens if there is a transaction or not a transaction and the kind of the different things that happen at the end.
Yep. Okay. Yeah, let's jump pretty quickly here, and we'll get to the long-term plan. But as I said kind of before, our philosophy is that there is one plan with two performance periods, right? So when you're the variable component of pay for this executive here, that this value creator, is we're going to create an annual plan, typically that is going to be based on profits, annual profits. Hey, here we go right here. We're going to set up a plan that has usually a range of opportunity and a range of rewards for you. So we're almost always going to set a threshold, right? A base threshold for this annual incentive plan that says we have to hit at least X in revenues and profits. We do like both as metrics here for that, but there's a minimum, right? There's a base that we have to hit before we start paying incentives. You don't pay incentives on the first dollar of profit that you earn in a year, right? There's some level we need to get up to, and we call that the threshold. And literally between the threshold and what we call target's really our budget for the year. What's budgeted revenues? What are budgeted profits for the year? And that's the target we set. And then if we hit that target, that's where that executive would earn their target bonus, which might be expressed as a percentage of salary. It might be a flat dollar amount. You can express them in multiple ways. And then we want something.
These are things that they can control too. Like, and because I've seen so many times where, like, you know, you might put an annual plan in, but the president can't control certain factors, or they're driving the wrong behavior. So you want to make this as simple as possible.
It is, right? That's why we usually use revenue and profits, right? If it's solely profit focused, do you really want that guy, just solely focused on 1 year's profit at the expense potentially of some growth opportunities that might present themselves? And so we usually do have a dual metric plan there that is focused on both of them there. And he has full control, right? I mean, he should have full control and full visibility on this, and the ability, we believe, to be uncapped. I think one of the things you see often on times here is, I want to put a cap on these things. And we would say, why? If you construct this right, and if you build the metrics right, and you build his or her opportunity right in there, these are the best checks you can ever write, right? Is your annual bonus checks, because you constructed it right. We're usually sharing, a fraction of the profits here with that person. And so I think constructed right, the annual incentive plan speaks to driving annual profitability, revenue growth for us, and it speaks to those things. The second period is what we're talking about, which is now this longer term period, right? And it's saying, hey, let's reward you for building enterprise value over time. And so if our budgeted profit number, just like you said, because that's our current number, is $1 million a year, we might base that million on earning your annual bonus this year, but it's also a starting point for our value creation. And so we'll continue along the lines of the $5 million valuation here, and assume we're going to use a phantom equity type plan. Well, that's kind of our baseline, if you will, right? Is we would construct it almost exactly like you described. We would say, let's pick usually EBITDA as a valuation metric, although it doesn't have to be. It can be anything you want. You can truly go out, get a valuation done. I think it's unnecessary, but you certainly can. And it could be other metrics, but I think in the marketplace in general, EBITDA multiple is a very commonly used valuation metric. And it's also easy.
I was just going to say, if I can add the note there too, because when we were having our conversation prior to this, whether it's normalized EBITDA or as you're going into this, talk about debt and actually the equity value too, Craig, because I think, there's, depending on how you, if it's a private business owner, they don't want, as they're sharing their financials, they don't want, if I'm hiring you as my CEO, all of a sudden now I've got to not have all these perks because I'm impacting you. So just weave that into the conversation.
Yeah, it is for sure, right? I think so. If we would think about the perfect formula for these plans would be EBITDA times a multiple minus debt plus cash. Okay, so pretty common valuation metric for the plan. Now, when we say EBITDA, it's never going to be the EBITDA from your financial statement. Okay. It's never going to be that number, mostly because we first need it for valuation, but these plans create a liability and thus an accrual charge to earnings every year. And so no matter what, it's always going to be what we call plan EBITDA. And so we want to call it plan EBITDA because then we can define what we mean by that in the document on the actual metric. And so that EBITDA might have all kinds of add backs in it, such as we normalize EBITDA for shareholder compensation, or we take shareholder compensation out altogether, right? Because if we're measuring improvement over time, it doesn't make any difference. As long as we pick the same metric from the beginning, and this is an appreciation plan, then we just keep that same thing. So sometimes we actually take shareholder comp out of it completely, or we'll just put a normalized number in there that we say every year, and potentially over time it might go up depending on the role of shareholders. So if the shareholder is acting as the CEO and we're having a president or CFO we're doing this for, we're going to put normalized comp in for that particular position, right? And that region and all the other things that go into kind of a market pay there.
Well, and this should be something that the president or whoever the executives are that are getting hired, they should be able to control these things, right? So even if you are the owner and you're saying, hey, I want to be still having these perks, whether that's you're just tracking that and pulling it out, or you're putting it into SG&A that maybe that person doesn't have a say in. You're just getting to the point where it's okay. You have to clarify those metrics because otherwise you could be counterproductive as how people are focusing on where to spend the money and the resources.
Yes, that is true. That is true. And the same thing happens with one-time expenses or one-time incomes coming in as well in the plan, right? We're gonna say in plan EBITDA that we're probably going to exclude those types of things, or at least there's going to be a discussion about excluding them or including them in there, right? We have a big expense coming up and it just makes sense to do it. And that's why we're doing it. Hey, we might exclude it from that year's EBITDA because it's just a one-time thing. And we don't want it to hit and crush value, even though really earnings might've been up. Same thing. If, hey, the company might own a building or something and sell that building in a year and create a whole bunch of EBITDA for no reason of the executives doing, right? And so things like that and thinking ahead about those are important. And I think it goes back to just like you said. I think if the people who are going to be in the plan understand your philosophy, and you can explain that philosophy of, hey, here's how we create value in this organization, and this plan, look at it right here. Here's the description of it. Here's the legal plan document. Here's how we share that value with those who help us create it. And I think once you get that culture built, all these little nuances within the formulas and all those in there, everybody trusts each other in them, and you create a plan. I think that is around trust in here as well.
So then if we go back and say, okay, like if we got $1 million, now that we've clarified, like you said, it's important that we've clarified how we get to that EBITDA. Again, the importance of clean financials, but we've got a clear understanding and it's tracked about how we find that EBITDA. Then, like you said, so it starts with EBITDA, then it gets to a multiple, and then we have debt and cash. So like, how is it then that, what percentages and how are you picking what percentages and how the shares are vested over, let's say it's a 36 or 48 month value growth track to get to that value. And so how are you then also determining the multiple and what that valuation is?
Yeah. So our typical thought process on this is that the multiple should be slightly conservative to what we believe the market multiple is, right? So I think that's the biggest mistake I think we see when they're constructing the valuation methodology is too much focus on market value, right? Within the plan. Oh my God, we have to make this perfect so that it's exactly replicating market value. And you really can't do that without having a complex formula that's probably changing your multiple over time based on market conditions and that. So what we're saying here is be conservative. If you believe you can sell your business for 6 or 8 times multiple, then make the multiple 5 in the plan, right? If you believe you can sell for 10, make it maybe 8 or 7 in the plan. And I'll talk about that in a minute and why that's important. But the main reason for wanting it to be conservative to the market multiple is if we're using vesting in this plan, so that's the term you've used a little bit already, but the term it basically means if I'm vested, it's mine, right? And that means it's mine if I leave, right? And we have a separation and we agree to go our separate ways and I'm vested in some value, then you have to pay me that value. And so that's the first reason why then we want a conservative multiples because we don't know what we're going to get eventually. And I'm paying you some value now, and I want to make sure I'm not overpaying you to the market. Okay. And if you truly want a market multiple, then you need to stick around until the event happens, right? Until the transaction happens, because at that point, we can then share that market value with you when that time comes.
I don't know how much I've talked about it on the podcast, but in our educational material, we talk about intrinsic value versus transaction value, where intrinsic is purely the valuation based on the discounted cash flow, and it's based on the risk of your cash flow. Like that is as the business stands by itself today. And ESOPs are going to look heavily at that valuation. But most financial buyers are going to, and then the transaction value is synergistic, where you might be getting a premium or whatever. And to your point, the discounted cash flow, that's something that's like very easy to determine. And it tends to be more conservative based on depending where the market's at. So I think it's good for everybody also to note that it's not like the owner is suppressing the value. It's just you don't know what that transaction value is until there's an actual buy, or like the baton's handed off to whoever that buyer is.
Yeah, that's exactly right. Right. It's saying why can I take that risk of sharing what we're guessing at market value right now when we haven't really realized what that value is yet. And so especially goes back to what you said before, is if I've decided I want to share 10% of the increase in value of my business over this next 5-year window with you, but I overestimate the multiple that I'm getting, guess what? I probably ended up sharing 12 or 15% of what the actual market value was because I overshared in this plan, versus the opposite, versus the message to the executive, which is I'm going to fairly compensate you. We're going to fairly determine the value of the business. And hey, if we can get out there and get this ridiculously high multiple that you see running around out there in the markets today, then and you're here and you helped drive that, you're going to participate in it when the sale comes. Because most of our plans we design, when the transaction happens, we convert from this formula we were using to the actual market value that we sold the company for, what we call sales proceeds.
So I want to get to that in a second, but I want to also continue to lay in a couple pieces of groundwork here. So talk about like how the shares are created, how that vesting schedule works, and what happens on the balance sheet. So as the liabilities accruing, and then because when we get to the transaction, we're going to talk about like if it's not sold, different exits. I know there's a lot to talk about there, but let's say that as the journey is unfolding over this 3 to 5 years of value growth, how are you actually tracking and measuring and seeing all the data, the financial data that you're talking about?
Yep. Okay. So let's just continue on with our example we were using. Let's just assume plan EBITDA for a minute was the $1 million in our 5 multiple. So let's just assume there's no debt and no cash right now, just so we'll make our numbers easy at this point here. So we have a $5 million entity. So then within the phantom plan, we need to unitize that or create a share value. We have to have shares. The shares or the units or whatever you want to call them within this plan, they're our currency that we use to be able to give to people, right? An award to people. And so we have to pick a total number of shares so that we can unitize that $5 million. I'd say our most common that we use is 1 million shares, right? This is not tied in any way to anybody's capitalization. We don't need the same number of shares. We don't need anything like that. We just pick a number. If you like low price stock as the message you're giving, you can use 10 million shares. If you like high price, we can make it 100,000 shares. It makes no difference here, right? It's just getting us to a unit value. So for our purposes and my poor math skills, we'll use 1 million because that's then going to create the $5 share price, right? So now we have the currency, we have these shares based on last year's $1 million EBITDA, no debt, no cash. We've got a $5 share price. And so I now have the ability to say to this new person that I've hired, here is a share, right? I can give the whole share if I want to. And if I gave you 1 share at that point in time, I'm giving you $5 because that's what it's worth at that point in time. But more likely than not, if we're building this on our growth assumptions, what we're going to say is, I'm going to give you 1 appreciation award, right? A stock appreciation right or a stock appreciation award that says, here's the starting value at 5. I'm going to give you 1 of these right now. And if you can't grow EBITDA more than above $1 million, it's always going to stay at $5 and there's no appreciation and thus there's no value for you at that point in time. Okay. So now that I have that currency, I'm going to make that award. And let's assume we're on an appreciation track here, is I'm going to give you that award. But the beauty of the long-term plans for the business owner is I'm really not going to give it to you yet. It's not yours yet, right? So we're going to attach some restrictions to that, if you will, that things that have to happen before you can have some value in that award. And the first and most common people are used to is vesting, right? And that's kind of how I used that term before, and make sure that people understand if it's vested, it means it's mine or his or whoever owns it there, right? That's who it is. And so and that means usually also there are some things we can put in there, but it typically means if somebody leaves and there's been some appreciation. So imagine I give you one of these awards. Let's assume we use a 4-year vesting schedule that just does straight line vesting at 25% a year. And let's assume that over the first 2 years, I vest in half of that one share, but it's now worth $8 2 years down the road. So there's been $3 of appreciation that I'm entitled to, and I'm 50% vested, and I leave, you got to write me a check for $1.50 for that one share, right? You owe it to me, okay? And so that's the first place that we often have people think is, where is the business headed? And am I willing to do that? If there is value created in this appreciation award and the person leaves or quits, do I want to pay them, right? Because if we don't, then we don't want to use vesting in these terms, right? We don't want to say you're vested. We want to say it's either a longer period. It could also be performance-based vesting, right? It can be time-based, and hey, you have to drive EBITDA up to $1.5 million before I'm going to even share any of that existing value with you, right? So that's the first step in understanding what people are getting and what they truly have. What goes with that is the second thing you brought up, which is that liability, right? So this is a long-term cash-based plan, and so you need to create the liability on your balance sheet, which is close to vested value. All right. You can think of it in those terms, but ultimately it is, hey, what do I owe and when do I owe it? And so by the time it hits 100% vesting, you need to have accrued the entire expense for it. So you get the liability on the balance sheet. You also get an annual charge to earnings, right? An expense each year, right? It's non-cash, so non-tax, right? But I've got to create that award, and it's actually going to reduce my EBITDA each year. And so we're going to create the value before that hits, because otherwise we'd have a circular calculation there we'd never get to. But it needs to be adjusted then each year, right? This is variable accounting. So each year as the value goes up, I have another little charge to my earnings that goes up as it goes up. If it drops down, I can recoup some of that expense that I had before back out of that. And so now that's how I'm paying for this plan over a period of time, because when it comes time to pay somebody, you'll have already accrued the expense. You'll just be writing the check in form of cash when it comes time to do that.
So there's a couple of important concepts that I want to dive into here, Craig, is that, everything that we're just talking about right now, if the owners listening in haven't shifted their mindset towards focusing on value creation, you're constantly going to be look at what I'm giving up. It's the scarcity mentality versus the abundance mentality of this is for value growth, right? So it's so important, because otherwise you're just going to be in this hamster wheel of trying to do everything yourself and, sucking every living annual dollar out of this, instead of the when and how can I get the value creation and harvest the actual financial reward of building this company. And if there's no idea of any kind of exit, then you're going to constantly be looking at this like an expense instead of there's a return on investment, because this is truly what this is. So, and I think you're as you're talking about the vesting and how all those different things work, I mean, you can truly be as creative as you want, right? I mean, this is like, once you understand what you want, this is all just going in. When maybe kind of describe the plan documents and how like the tracking and measuring of this is successful over time, because I mean, truly plan document, and then you have the right tools to track it.
Yeah. Yes, you can be in the design of these plans. It's almost anything goes as you design them, right? And then as we document them, then we have to live by the contracts that we're creating there. But I think there's kind of two ends of the spectrum you think about. If you are on a track that says we're selling this business, we're going to a transaction sometime in the next 5 years, I think it's possible to just create a plan that says to that person you're bringing in, hey, here's some phantom shares, and these shares are going to be paid when we hit the transaction. And they're never vested before that, right? Because this is where we're going, and this is why I'm hiring you. And it's a simple plan that everybody understands. And that person being hired says, I'm all for that because this is where we're going. The pitfalls of that are, what if track changes later? And you gave me something three years ago, and now I've turned this into this big profitable business and you decide, boy, I like this cash flow. This is going to become a lifestyle business for me. And now that CEO you hired or president you hired is sitting there saying, wait a minute, I only have these shares that pay in the event of a transaction. And now the transaction doesn't look as likely. Okay. And so that's the problem with that. If I know that's where I'm going and I'm definitely going there, that type of design can work. But by and large, the person creating the value wants to know he can be paid for that value in more than just a transaction setting, right? And that's the idea behind vesting and other payment events in your plan and building those into the legal plan documents, right? That say things like, hey, if I vest and eventually I leave before a transaction, I can get paid. In theory, if we've got our formula value conservative to the market value, then and we based it on EBITDA, I should have the value to pay that person. And I think the scarcity mentality is solved by these appreciation-only awards, right? Because we're only creating value if we've driven up EBITDA here. And typically in these plans, most shareholders are only going to share somewhere between 10 and 20% of appreciated value over some period of time. And so I'm not sharing it all, right? If I'm the sole shareholder, I'm getting the other 80 or 90% myself there. And so I think constructed right, you really can overcome this scarcity mentality and the expense mentality of it over that period of time.
Well, and we talked about it earlier where you wouldn't do this if it wasn't possible without them, right? Like, so everybody's going, if they're going, well, 10 to 20% of that 12 million bucks. I mean, that's like, but if you couldn't do it without them, that's your answer.
Yep.
And also the, you know, I think what's interesting is like what I've seen go wrong. And then I want to kind of talk about if there is a transaction, not a transaction, and how do you make sure that you're accounting for this correctly so you don't get into a pinch where you owe someone $2 million and you don't have the cash for it. I just think that like,
yep.
So I'll go with the stories that I've heard of, okay, Craig, you're my executive, you vested, and now you've got 15% of my company that potentially is worth 50 million, but we never do a valuation. And I've seen it where like, and I've got some people that I know who are in that situation and they're the executive. There's nothing more toxic for the relationship, for the culture, because there's this hypothetical sale that the company only has the cash to pay the person if it sells, but now it's a lifestyle business. The owner's bought a plane and you have one majorly resentful executive who cannot get out. And there's nothing more destructive for everybody. And I think it's because they didn't save the cash. There's no expectations. The plan changed. I'm sure you've heard that story, XYZ individual 1,000 times.
Yep. And I think that's one of the other things phantom stock can do for you is the one major difference in these than the actual equity is we have to build in all the events for payment right ahead of time. And so we at least have to speak to them in the plan document. And those are what happens if a person separates from service? What happens if they die? What happens if they become disabled? What happens if we sell the company, right? We kind of have to say what happens there. We also can build in another one that is a scheduled distribution, right? So we can build on one that's time-based in there that says, hey, I'm going to give you some of these awards today and I'm going to cash them in 5 years or 6 years or 8 years in there. But along with that annual accrual expense, we highly encourage that the business should be funding this plan, right? Because it's going to help create the value of your business. If I have this naked liability just growing on my balance sheet that's showing I owe this guy $1 million and I have no corresponding asset with it, it's just lowering the value of your business. The second point to make on that is if you set some money aside, and when I say set it aside, right, this is just another balance sheet asset here. We can't set the money aside. We can't protect it from creditors. It's an asset of the company, but it's earmarked for the value of this plan. And what I like to equivalent to is it's saving and it's making the person who's helping create the value also pay for his own value, right? So it's taking some of that EBITDA each year and saying, set it aside instead of our Social Security model that eventually hits this tipping point where we don't have enough people paying for it, right? Like your example, we get out there 10 years, we owe this guy $1 million, we've saved nothing for it, and he wants to leave now, and I have to pay him his $1 million over the next 5 years. Let's say that's how we built the plan. Well, now I'm burdening my new president I'm hiring to be able to pay this guy $200,000 a year to get him to his $1 million after he's retired, as opposed to saying, let's set some money aside and then it's there and I can pay it. And we took it out of his earnings, which were what was driving that value up to begin with.
How many times do you see that people run into the complications that I explained because they're not disciplined to track all this stuff?
Yeah, I think you see it a lot, right? And even I think more importantly than that, right, is that that means you're also not communicating the plan and the plan value to your participant, which is one of the most valuable pieces of these plans, right? Is communicating them, understanding how they work. Because I didn't quite get to it, but I think it's important to note is when you develop these plans is don't just give out whatever you're going to give all at one time to this person. Don't hire that president. If the deal is to get him 10% of the appreciated value, don't just, and in our example, we used 1 million phantom shares. Don't give him 100,000 of those appreciation only shares all in the first year. Multiple reasons, right? I don't care how sure you are, you're never that sure, okay, of this person. and things change, okay? And if you give something all at one time and attach a vesting schedule to it, then at that some one point in time in the future, he becomes 100% vested. What we would recommend is make the awards over a couple of year period of time or even more, right? Get him to his 10% if that's what you want him to have by giving him 20,000 shares a year for 5 years and attach a new vesting schedule each time. And then more important than that, attach a new starting value each time as EBITDA is going up. So he has a new hurdle to go above, right? So his first hurdle was $5, and then he got another 20,000 shares at $6.50 and another at $8. And so you're constantly getting him to strive forward, not going, hey, I got 100,000 at $5 and we're sitting here at 15. So I've got my $1 million and I'm happy.
So then let's say you've got a lot of this stuff accomplished and we're going back to our case study and saying, okay, the goal is to get to 2 million so I can have a $12 million value company. So truly as the business owner, I just want more options, right? I can get a higher multiple. I'm in investment banking material. I could do an ESOP. I could sell to private equity, maybe the strategic that's been chasing me, just truly options, and the ability to walk away. So as the options come, you have more choices, obviously. So therefore you may decide not to sell, or maybe you say, well, the next $1 million is going to give me another 10 million in value because of all these different reasons. So how do you address that liability and the executives who are sitting there? Well, let's say she says, you know what, I want out, and I had a 5-year timeline. You decided not to sell this year. COVID happened. I'm drained. All those things that life and business happen. How do you address that if the track changes for both parties?
Mm-hmm. Yeah, so vesting's going to start to deal with that, right? If the person decides, hey, we made it out 5 years, but let's assume we did what I just recommended, which we gave you some shares over the period of time. And so I'm going to be some percentage vested in all of my awards, maybe 100% vested in the first ones I got, down to 20 or 40% vested in the ones you gave me recently. And that person says they want to leave, then that's what vesting means. We're going to pay them, right? But typically we're going to design into the plan. We're not going to pay you all at one time, right? We're going to say, hey, we're going to pay you, but we're going to pay you over some period of time. 2 to 5 years can be seen in these plans here. And kind of an interesting aside there too, we can tie those payments to that person not competing with you as well, right? So not a non-compete agreement, but it's an agreement that says if you go out there and try to take some of our customers or take some of our employees, we're going to stop making these payments. So kind of a little tool you can use in there. But ultimately, you're able to pay that person. You've already accrued the expense, right, via your balance sheet, because that person's vested, and that's almost always what you have accrued is at least the vested value. And then I'm going to pay that person at the formula value, right? And so at that formula value that we agreed to along the way, and I'm going to make those payments. Hopefully, I set some money aside so I have it, and I'm not trying to pull it all out of earnings going forward. But either way, I'm going to pay that person over that period of time. I think the flip side is we do get to the transaction, right? The flip side is we get to that transaction, and instead of a 5 multiple, we sell for an 8 multiple, right? And you don't have to share that market multiple with you, but I highly encourage it in all of our plans, right? It puts everybody shooting for the same thing. It creates the perfect alignment with shareholders and participants, and we then convert that value to the transaction value. And so if we were formula valuing the company, let's say we had just doubled EBITDA from 1 million to 2, so now our company's worth 10 million according to this person's plan value, but we really sell for 15 million, right? We're going to now convert the value of that person's shares to that $15 million number, okay? And this is the reason that it's important to not be too conservative in your valuation model, because remember, we awarded all of these appreciation only shares at a 5 multiple, but just sold at an 8. So they just got a 60% bump in value in their appreciation because of this new value here. Okay. And so we don't want that to be way different. We don't want a 2 multiple selling for an 8 because your liability just tripled on when it comes time to pay. So when I say be conservative, but not too conservative, so that we don't get a surprise at a sale if we sell way more. You're always going to have the money. And the percentage of the increase in value is going to stay close to the same, but you're going to get surprised on how much money you owe that person if you were too conservative in your model there.
And you just hit on something I think is super important, is that when we are modeling out the out-year projections because you can model out the future value growth like you and I are talking about, and that's what's so important, is that's kind of like an assumption that people are doing that. You can actually model out the net proceeds. So like as this liability is on your balance sheet, and if you were to transact, you can say this is still how much would go into my pocket. So you're not just guessing at the end how much is going to go into your pocketbook. And it's also, I think, what's interesting is like, it's also important to be conservative too, Craig, because the last thing I would ever want is someone where they're let's say you get to the 2 million in EBITDA and the transaction value of a third party could pay that 8 multiple, but they want to do an ESOP because they've already got enough money. And they're like, you know what? I want to go this route. You don't have someone that's responsible for driving your whole company, going against you to try and get that bump that they originally thought was there. I think it's just, there's a potential for conflict there.
Yep. There definitely is. And so I think it goes back to look at all the plans we want to be fair as much as we can. And I think, right, if everybody has to have that attitude going in that, hey, we're doing this here because we believe in each other. We believe you can help me create value and I'm willing to share it with you, right? We're never doing these plans in the negative, right? That you're forcing me to do this and you've got me over a barrel and that's why I'm doing it. It's the wrong premise going in. You'll never have a plan that really is the purpose of these plans, which is the plan itself and the results is the celebration of great results. That's what these plans are. It's not trying to influence your behavior. It's not hanging just the carrot and the stick and saying, hey, do this and this happens. It's saying, look, if we can do this together, this is the celebration of results. This is the expression of us succeeding, and it's a win-win for both sides.
One thing too, like going back to the transaction, I think you and I in one of our conversations had talked about how if the goal was to transact is to have that where they get paid out on staying with that third party. So that way they're not just all of a sudden getting their money and walking away, and they were crucial for the deal. Any insights you have on examples?
Yep, absolutely. So it depends on the position, I think, a lot, and depending on the number of people, but almost can turn the plan into a negative if the new buyer sees, wow, you're going to write all these big checks to these my executives here. It's the whole team, and they might now walk. And so we don't ever want this plan to be a detriment to a potential transaction. And so you do see what you described quite often in here, which is sometimes both vesting and payment being tied to those people staying for some period of time, right? So we would have, once the transaction is triggered, right, is we might vest and pay an executive half of what they're owed at the transaction, right? And then what we say to that person is, stick around for another year, stick around for another 18 months, stick whatever number you think is right in there, and stick around for that period of time, and we'll pay you the other half, right? Or we'll pay you 25, the other 25% in 9 months and 25 more in 9 more months for 18 months. So any of those work where that you say to that person, but if you just quit the business, you're going to forfeit that last part of that value, so we get you to stay there. Sometimes what it also does is allows a honeymoon period, if you will, between the new business owner and this exec to work out their own deal going forward, right? Instead of having it just be over a barrel when the exec's got all his money in that period of time and he's driving all of it. He gives those two a period of time to work it out. And you also always build in that if the new buyer then terminates that person in that period of time, the person gets all of their money, right? So it's only if they have a voluntary separation where they forfeit. So
as we're kind of wrapping up here, I think, what are, you in Vision Link, you talk a lot about communication. So explain a lot. You can be as creative as you want. You have to know certain things about your business and have clarity and being able to track these things. Then it comes down to communication. Can you talk about the most effective ways you've seen entrepreneurs and owners roll this out and then see the long-term success?
Yeah, I think it is a key in all compensation plans, but this one especially, right? Because we're talking about out in the future, things that we hope to happen out in the future. And so I think the communication revolve around first making sure everybody understands the plan and is extremely clear on how it works and what it's supposed to accomplish, right? So what's this purpose of our plan? So that's when it comes time to we finish designing the plan and we've done the plan, legal plan document. It's the enrollment materials where we're getting that person to understand. It's possibly some projections of what can happen out into the future. These shouldn't be just a surprise that this first time an exec's seen, right? He knows what the opportunity here is. This is just quantifying what he might be able to achieve over a period of time. And so I think having a good system that can both project out your plan as well as then help you monitor and manage that plan going forward and create new awards on an annual basis. So the other reason we like new awards, right? It's a new expression of me giving you something new on an annual basis and then tracking those and sending you annual statements that say, hey, here's where you stand right now. We gave you some shares at $5. They're worth $6. Here's how much you're vested. We just gave you some more at $6. And constantly communicating, especially if things change, what the possibilities are out there in that plan. And so that people understand and see where they are and see what that potential value could mean to them. And we do that with what we call an employee value statement also. So it's added onto this, and it takes a look really at all of their compensation, right? It takes a look at salaries and potential annual bonuses in addition to this phantom stock value and says, hey, you might be a $200,000 a year executive, but look at what can happen over the next 5 years if we hit our plan here. You can earn this much in annual bonus. Your long-term value plan of stock's going to be worth Y. This isn't a $200,000 a year opportunity. This is a $2 or $3 million opportunity over the next 5 years if we hit our goals.
There's a couple components in this that I see to be successful besides just the communication is the financial clarity to being able to track all this stuff, right? Because everybody's got to be able to have there's got to be integrity in the data so we can look at this and say, yeah, you're right. We are accomplishing this or not accomplishing this. The other is this plan document. And can you explain a little bit more for someone that's having a hard time, the visual people that are listening in saying, okay, what is it? So yes, we can track the shares and the vesting and the liabilities, but like, what the hell is this plan document? And then are we committing to something that may or may not change, as life and business changes? So kind of explain the plan document. And then if someone is driving towards that transaction at 2 million and 12 million value, and they decided to change their mind, explain how the plan document accounts for the kind of the choose your own adventure.
Yeah. So the long-term plan is a long-term promise to pay, right? And the plan document itself just describes all the legal conditions around that contract. Okay. And then when we make an award of phantom shares, that person gets, we can term this any way we want, but it's in essence a participation agreement, and it outlines all the terms and conditions of what we gave them. So how many units, the price of those units, the vesting schedule, and it kind of marries them back to the plan document. The plan document is a legal document. It's a company document. It's private. You don't file it anywhere, but it is all the terms and conditions everybody has to live up to under the plan. And so when we give out awards and give a participation agreement, it abides by those terms and conditions of the plan document. If we want to change any of those later, we can never change what we've already given. So if we've given something out and we've said this is how we're going to deal with those, then we have to live up to that. Both sides have to live up to that, right? If we change and say, hey, you know what? We want to give some new awards and we want them to have some different terms and conditions, then we can do that. But ultimately, it's the legal document. It's kind of the guiding principles of the plan and how we have to abide by that. And it is contractual, right? I think that's the benefit that participants get, just like they would if you gave them equity. This is a contract and a promise to pay. And so if we have built-in events for payment that were only around a sale, that's a problem with the design if we change that later. It doesn't mean we can't give them something new, though, at that point in time. And we can even give them something new that started at the previous value. So you have a little more flexibility in phantom shares than you do actual stock options that you can't give in the money stock options, but we can give in the money phantom appreciation rights.
I mean, it's truly just being intentional about thinking through all the different things that could happen and then writing them down. You know what I mean? It is. It's just foresight on how you want the different things to unfold, and then just putting it in the document.
It is.
I think you kind of covered it just a little bit, and then we can wrap up here. Is like, what if the company value goes down? So how does that? Because I'm just thinking of all the people that are thinking of all the objections that they might have. What happens if the opposite happens?
Yeah. Yeah. It's actually the perfect plan for that, believe it or not, right? And it's the perfect plan to not give all the awards at once. So back to our example, if I wanted you to have 10%, I gave you 100,000 awards at $5, and 3 years later, we're sitting at 350, right? And I have a bunch of underwater, stock appreciation rights here. And it's pretty depressing. I probably have a pretty good chance of, maybe losing that person, and maybe I need to lose that person. Maybe that's the reason we're at 350 instead of $5. But nonetheless, maybe it's not. Maybe COVID hit, right? And you have some other reason for that. It's the first reason to not give all the awards at one time, because if I gave you some at 5 and I only gave you some portion of them, and now we dropped to 350. I can give you some new awards at 350, right? That have a new lower starting value, that have the ability to be in the money faster just by getting back to our starting value of 5. And so the continuously awarding of shares based on where our value is, our formula value is over a period of time, this works great. And because what better message can you send to your person in that year, which is, hey, listen, we just had a really lousy year, obviously. You didn't earn a bonus, more than likely, right? If our share price dropped from 5 to 350, we didn't pay you a bonus, but guess what? I still believe in you and our future, so I'm giving you some more of these units at 350 because I believe we can still get to that $12 number.
Super cool. We covered some awesome ground here. I don't know if there's anything that is lingering out there that you want to make sure we cover before we wrap up.
Yeah, I do. I think obviously we delved into it pretty deep. I think when you build the plans, don't over-engineer them, and don't try to think of every possibility out there, right? I think it is, think of the main ones that are going to have the most effect, and build a plan that is thought of as a value sharer, right? And not an expense. And it has an expense, and we're going to see that on my balance sheet, but ultimately I'm sharing value that this person or persons are helping create.
So perfect. 2 last questions. One is, what does the word intentional mean to you?
Intentional? Intentional is, that's the outcome that I want. This is what I mean to happen.
And then it's awesome. Very straight to the point and very clear. I love it. And what is the best place to find more about you, VisionLink, and all the materials that you guys have out there?
Yeah. Like anybody, we believe we have a really strong website. So we created 2 websites. Our standard website, which is vladvisors.com, so visionlinkadvisors.com, has all of the information about our firm and the different services we have. We created another site at phantomstockonline.com. So this is obviously we built it as kind of a wiki site. So it's informational here, where you can literally go in and build a sample plan for your own company in there. It has a tool in there that you literally can use that and go in and do it. It has white papers. It has all kinds of basically free information that you can go and find out more about it. And that's phantomstockonline.com.
Greg, this has been a blast, man. I appreciate you coming on.
You bet, Ryan. I appreciate you having me.